Hi, this is Rasa Tefi. I'm the founder and senior wealth advisor of Yatra Wealth Design. And today I'm going to be talking about our investment philosophy. So the first question that comes to mind is, why have an investment philosophy? What's so important about that? So I'm going to get into that. I'm also going to be talking about the benefits of having an investment philosophy. And then we'll get into the details of our specific investment philosophy and how it can be beneficial for you. So why have an investment philosophy? Investing is a key component of your long-term financial plan and future. Investing can be challenging, complex, and feel scary at times. And studies like this one, the Dalbar study, demonstrate that most investors substantially underperform due to emotional decision-making and a lack of an investment philosophy. So what are the benefits of having a well-thought-out investment philosophy? Number one, we can simplify and improve decision-making. Number two, we can minimize potential mistakes. Number three, we can increase your probability of success over time. So what is our investment philosophy? The following are the 8 core tenets of our investment philosophy. Number one, we provide customized portfolios for our clients. Number two, fiduciary management. Number three, invest for the long run. Number four, diversification, invest like an institution. Number five, asset allocation determines everything. Number six, understand and minimize risk. Number seven, minimize costs. And number 8, stay humble. So I'm going to go into each one of these individually and go into more detail. So number one, customized portfolios. Your portfolio will be customized and in line with, number one, your goals and financial plan. Number two, your specific risk tolerance. And number three, the current economic and market conditions. Having a customized portfolio in line with these 3 things will substantially improve your long-term outcomes. Number two, fiduciary management. So what that means is we recommend investments because they're in your best interest, not because they pay us. As fiduciaries, we're trying to minimize conflicts of interest. And what that really means is we don't get paid differently for one type of investment versus another, unlike most advisors out there. And that minimizes conflict of interest because, again, you know that we're not recommending an investment because it's better for us. It's just because we think it's the right strategy for you. So number three, we want to invest for the long run. And we break this down into a few different components. Number one is we want to buy low and sell high over time. And really what that means is, as Warren Buffett would say, we want to be fearful when others are greedy, and we want to be greedy when others are fearful. And unfortunately, most investors kind of do the opposite. And most investors will invest a lot of money and get really aggressive after the market's been going up for a long time. They say, oh, the market's doing well, let me get in now. And then unfortunately, that's usually right around the time when the market's about to turn back around and start to go down, right? And then on the flip side, after the market's been on a downward trend for a while, investors are saying, oh, the market's not good, the market's scary, I'm gonna get out. And unfortunately, they end up selling at the bottom, right? And we want to do the opposite. And over the long run, this done effectively will result in positive outcomes for our clients. Another aspect of investing for the long run is that valuations matter and revert to the mean or the average. And that doesn't necessarily tell us what's going to happen in the short term with different types of investments, but it does tell us if we're getting in at a time when prices are high or prices are low. And over the long run, it's very likely that valuations will impact your long run returns. Valuation is understanding the multiple on profits that we're paying for the stock market. As an example, that price to earnings ratio in the stock market is higher than 16 or 17, let's say closer to 20 or even higher than that. That means that we're buying in at a time when the stock market is relatively expensive. What we see is that buying in at a high price to earnings ratio very often results in lower returns over time, and buying at a historically low price to earnings ratio oftentimes results in a higher long-term return on your investment. So this isn't the only thing that we should consider when we make investment decisions, and it's not a foolproof concept, but it is something that's really critical, and we should always consider it when making investment decisions. Additionally, in investing for the long run, we want to make sure that we don't get enamored with the hot new fad of the day. And last, that markets go up over time. So there may be volatility but the stock market is essentially just a collection of the biggest and best companies in the world that make and sell all the important things that we buy and consume on a day-to-day basis. And so as long as there's more people becoming more productive over time, the stock market will continue to go up. If you'd like to learn more about the concepts of valuation and mean reversion and how to utilize them in your investment process, we'll have a separate video discussing this in more depth and going into more detail about it. So number 4 is that asset allocation determines everything. And research has shown that 91% of returns come from asset class selection, and only 9% comes from security selection and market timing. I think many investors think that investing is all about choosing the hot stocks or figuring out when to invest in the market and when to get out, and market timing. And in fact, research shows otherwise. And what's much more important is determining your asset allocation. So a very high level way of understanding asset allocation is how much do you have in stocks versus bonds versus cash? And then of course you can get into more details. We can drill down further and say, within the portion that we have in stocks, how much do we have in tech companies? How much do we have in energy companies? How much do we have in consumers and retail companies? How much do we have in small companies versus large companies? Each one of these is a different type of asset class. These decisions have an outsized effect and impact on what your returns will be and how your portfolio will respond to various things that happen in the markets and the economy. So this is truly the biggest investment decision that you'll make on a day-to-day, month-to-month, year-to-year basis. It's, again, asset allocation determines everything. And the way we approach it, as you can see by this chart here, is we always stay very diversified with your asset allocation. So we always have many different asset classes in your portfolio. And at the same time, we're going to be making intelligent decisions, rational decisions around how much to have in each asset class, how to diversify, which asset classes we should have more in versus less in, and when to make those adjustments. So that's going to be the biggest decision, the biggest component of our investment process is determining what our asset allocation is. Number 5 is diversification. Sub-bullet point, invest like an institution. So diversification can substantially reduce your risk and increases your probability of achieving your goals over time. This chart does a good job of demonstrating the value of diversification over time. So what we can see here is the years 2000 to 2002. Sometimes investors wonder, why not just put all my money in the S&P 500 and just let it ride and it'll go through ups and downs, but what's the point of being diversified? And the reality is diversification is crucial to increasing your probability of success and decreasing your risk. And so what we're showing here in this chart is a variety of different market environments over the last 20 plus years. And we're looking at how the S&P 500 did during those periods versus a diversified portfolio. And what you're seeing here is this is from the years 2000 to 2002. The S&P 500, so the 500 largest stocks in the US, were down over 40% over that 2-year period. Whereas a diversified portfolio, a portfolio that's made up of some US stocks, some international stocks, some large, some small, and then also some bonds, that portfolio was down about 17% over that period. So the diversified portfolio was down, but it was down less than half. And then from the periods 2003 to 2007, the S&P 500 did well, so it was up 83%, but the diversified portfolio did quite well also. It was actually up 80% over that period, and yet it had substantially less downside during the period before that. We can keep going down the list, but what you'll see there is the diversified portfolio is never the best performer, right? There's some years where the S&P 500 is the best. There's some years where the international markets are the best. Some years where the bond market is the best. But having that diversification is going to smooth out the ride, decrease your risk, and increase your probability of success and achieving your goals over time, which is what's most important as we're investing for your future. So continuing along with diversification, we want to invest like an institution. So what does that really mean? I mentioned we want to have a number of different asset classes, both in the stock markets, the bond markets, US, international, and we want to make smart asset allocation decisions. One Additional asset classes that we can add to the portfolio include private markets. Private markets means that we're making investments that are not publicly traded. And what we found and what evidence has shown is that private market investments can add diversification, reduce risk, and increase returns over time, which is, of course, what we're looking for. What we've seen is that large institutions make substantial investments into private market investments for the reasons that we just mentioned. And institutions are continuing to grow their private market investments. And in fact, most of the best institutions have a larger allocation of private markets. So the question is why? And the reality is private markets need to be a component of our portfolios and should be a component of our portfolios and a larger component over time, because there's been a long-term decline in the number of companies that are publicly traded. So publicly traded on the NASDAQ, on the New York Stock Exchange, et cetera, and on public stock markets and bond markets. And that decline, as you can see here in the orange line, it's been substantial. So since 1988, we've had a decline of 36% less companies are publicly traded over that period. Whereas if we look at private companies with 100 plus employees or more from 1988 to 2017, there's been a 41% increase in private companies with 100 plus employees, so fairly large organizations. And we can see here on these two graphs, on the left-hand side in North America, we're looking at the percentage of companies that are private versus public with revenue over $100 million. And you can see that the vast majority, that's the light blue here, the vast majority of companies with over $100 million a year of revenue are private companies. And only a small percentage are public companies. And it's the same thing in Europe and Asia. And so if we're not investing in the private markets, we're missing out on most of the economic value that's taking place in the world. And therefore, we're missing out on diversification benefits, we're missing out on growth benefits, and we're decreasing our probability of success, which is why we make it an important factor that we have investments in the private markets. Institutions and large investment managers also add other alternatives asset classes like gold, REITs, publicly traded and privately traded real estate, and various other asset classes as well. And studies have shown that those add diversification benefits and additional returns over time, which is why we also add those asset classes to the portfolio. So number 6 is understand and minimize risk. Now, there's really 3 types of risk when we talk about investing. Number 1 is principal risk. So principal risk is the risk that you could make an investment and lose some of that investment or lose some of your principal and never see it come back. That's the biggest risk when it comes to investing. The second type of risk is volatility risk. Now that's the risk that your portfolio or investments will fluctuate in value over time. Volatility would be different than principal risk because sometimes investments can go down temporarily, but recover. And the third type of risk is the risk of inflation. And inflation risk means that the cost of living is increasing over time. And if your investments aren't increasing with or hopefully outpacing the rate of inflation, it means that you're actually losing value over time. You're becoming less wealthy. Your expenses are growing faster than your assets. So that's a risk as well. We can most effectively mitigate principal risk through diversification and smart asset allocation decisions. In many cases, principal risk comes from being overexposed to maybe one particular stock, one particular security, or one particular asset class that has a lot of risk. Markets go up over time, but not every stock goes up over time. Many companies will go bankrupt or never reach their previous high points. So diversification makes a huge difference in reducing and hopefully eliminating that principal risk over time. The second is, of course, volatility risk is something we have a lot of control over. So again, based on your risk tolerance, your plan and goals, and the current economic and market conditions, we can kind of fine tune how much volatility risk we want to take in your portfolio and make sure that it's never too much volatility for you to handle or too much volatility for your plan. And then the third type of risk, inflation risk, that we're going to be able to mitigate and hopefully eliminate through smart investment decisions, growing the portfolio over time, and choosing investment asset classes that outpace inflation over time. It's also important to understand that years of high returns can be completely reversed by one bad year. And as we're seeing here in this chart, we've had some really substantial declines in the stock market. So you can see here in 2008, the S&P 500 declined by 48.76%. In 1931, we had a 57% decline. And we've had many declines over 20%, even 30%. And so we have to be really careful, and that's just in the S&P 500. Understanding this risk is going to help us to avoid making catastrophic mistakes. We also need to understand and manage sequence of returns risk. And what that is that poor returns early in retirement can substantially alter your ability to reach your retirement goals. And as we're shown here in this chart, we have two investors. The first investor, the purple investor, experiences a 15% decline in the first 2 years of retirement, and their portfolio, which starts at $1 million, is actually running out by year 18. Whereas the other investor, investor 2, experiences a 15% decline as well, but not until the 10th and 11th year of retirement. And for investor 2, you can see that they actually had $400,000 left over after 18 years. And the only difference between these two investors is that one of them had their down years in the beginning of retirement and the other one had their down years in the middle of retirement. Other than that, they had the same returns. That's the risk. That's a sequence of returns risk and something that we need to be very cognizant of in retirement planning. And the last point here, as I mentioned, is volatility is a choice. So we are able to dial up or dial down the potential volatility of your portfolio. And we're going to do that very consciously. Number 7 is minimize costs. So costs are inevitable when it comes to investing, but our goal is really to minimize these wherever possible and therefore maximize returns net of costs. And the last point here is stay humble. And this applies to us as well as our clients. And the reason why this is so important is that investing is all about weighing probabilities. No one has a crystal ball. No one knows for sure what's going to happen. So we're saying, hey, this outcome and these types of investments have a higher probability of paying off than this outcome or these investments. So let's put more here and less here. Let's put our portfolio in a position to benefit from the more likely outcomes. But we also want to consider what are the worst case scenarios, what are the best case scenarios, and how do we make sure we're as protected as possible. But again, no one has a crystal ball. No one knows what's going to happen. And we need to be humble enough to accept that. And that's why we diversify. We make sure that we're going to be okay and be successful in the broadest number of outcomes. Information is not knowledge, right? So a lot of times we think, oh, we saw this on the news or we read this, so then we can make a decision or change our portfolio based on that. But sometimes we hear a statistic or we hear something in the news, and that doesn't necessarily mean that we know how to apply it. So we need to be careful with information when we get it. We need to understand when it's knowledge and when it's just information. Ignore the talking heads, right? Everyone's got an opinion. There's a million opinions online and in the news, and it can be really confusing and contradictory. So we need to really ignore those talking heads and have a data-driven and stick to our philosophy. So past performance is no guarantee of future results. That is one of the most important, if not the most important concept when it comes to investing. We can't assume that just because an investment has done well in the past, it's going to continue to do well going forward. And in fact, in many cases, it's the opposite. So this is one of, if not the most important facets of investing. And the last one here, and we touched on this earlier, but I think it's important enough to touch on it again, is that most investors actually underperform the markets due to emotional decision-making and a lack of an investment philosophy, which is why we have an investment philosophy. And one of the most important ways that we think we can add value to your long-term financial plan over time. Thank you so much for your time. I really appreciate it. Please reach out to us if you have any questions or would like to discuss further.